Test. Hello, hello. Are we live? Can you hear me, Josh? Testing, testing. Hello, guys. Can you hear me out there?
Hold on.
I can hear you.
Okay, cool. It took a sec for it to pop in. It was, I was like, why can't I hear him? I see him talking.
No, we're all good. So, hey, guys, welcome back. Happy Wednesday. Do me a favor if you're watching out there. Let us know how the sound is. We were a little late getting on today, so things, aren't running quite as smoothly as they do normally. So, give us a heads up on that. And also, if you're watching out there, or when you're watching out there, let us know where you're watching from, what state you're in. I know we have people watching all over the place. Maybe you're in another country. I have people commenting on videos there too, so that would be helpful, just knowing where you're watching from. And
hey, Jeb, you know what also?
What's happening out there, my friend?
You know what also would be awesome, Jeb? If you're watching and you say, hey, I'm in Nevada, just say on a scale of 1 to 10, how hot is your market? For us, Jeb and I have been going through this all day. It went from 8 or 9 in the fall to about a 12 right now. So we just love to hear it. We know it's hot everywhere, but how hot? Are you seeing multiples if you're out making offers? Is it, would love to hear that feedback.
No, I think that's great, because I'm experiencing some sound issues here, man. So give me a second. All right, is that better? Much better. There we go.
You sound good from our end. I hear you, and they're saying you sound good.
All right, so that's better from my end. Yeah, so Josh and I have been talking a lot about this over the last couple of days, and we typically start with a rate update. We're gonna hold off on doing the rate update just for a little bit, because it seems to be a question that everyone has as we dive into the video a little bit longer. And some things have changed in the last couple of weeks that have impacted rates, and rates ultimately affect payments, which ultimately affects what people qualify for. And we've talked about this in videos, but we're going to talk about it. But just, if you have questions on rates, just give it a little bit and we'll dive into it. But Josh and I have been talking because, a lot of times we have mutual clients. Somebody comes to me, needs a loan. I refer them to Josh if they're here in Southern California. Sometimes they have their own lender or what have you. But, I'm putting in a lot of offers right now. Josh has other realtors he works with as well. And we're seeing similar results. And I'm sure a lot of you guys out there are seeing things that are also similar, which is putting in a lot of offers and getting outbid and being frustrated through the process, which is completely normal. But if you are putting in offers out there and you've got them accepted, would love to hear those success stories as well, because it's frustrating. It's frustrating from our side as real estate agents. It's frustrating from the mortgage side. It's frustrating from the buyer side. The only one here that's really having any fun is the sellers, and
as long as they don't have to be a buyer after selling.
And that is the catch, right? So some of these guys are on the buying side, and I have them, right? I have them where they're contingent on finding that replacement property, and it's been a arduous task to say the least. So, but that's where we're going to start. We're going to dive into some of these questions right to start and get things rolling. And then we'll talk about interest rates here in just a bit. So Brandon had started prior to going live asking to do a video on NACA. I actually push one out today around 4 p.m. my time. So about an hour ago, there was one out there. It goes over the details of qualifying for that program, what you need to know. If things seem too good to be true, they probably are. This seems to be one of those cases. And I know there's a lot of success stories out there with it, but understand in a market like we have right now that is extremely hot, things are selling well above the asking price. Sellers have full control. You're going to have a difficult time in most cases with that type of offer. I mean, even people putting 5% down, 10% down in our market are having issues. So, but the information's all in that video if you want information on that. So, and then I know we have people watching from SoCal, from Illinois, from Fort Worth, Texas, Las Vegas, LA, Phoenix. So appreciate you guys tuning in. But let's see here. So I'm going to save the should we wait or buy now question as well, because that's one that comes up quite a bit. Will I see home prices drop? Where will they be in 3 to 5 years? Josh, what are your thoughts on home prices 3 to 5 years from now?
So it's a long time horizon. If we continue to see what we've seen over the last couple of months, there will be a drop. The question becomes, where does it drop from? For those of us, for those listeners who've been watching for the last 3, 4, 5 months as we go through it, was pretty adamant that there's not going to be a downturn. Well, that was predicated on 5, 6, 7% annual appreciation. We saw numbers year over year come out in February for January, and nationwide, every market is unique and individual, but nationwide numbers were 10% year over year. We've accelerated since then. We had talked about the American Enterprise Institute projecting 11% this year and 9% next year. You can't have a rapid blow up in prices like that. And a lot of markets, some sub-markets are seeing like 15%, 17% year over year. And if you're in one of those markets, they just can't go up that way permanently. But let's answer the question. What does a downturn at the end of that look like that? Does it become, do we give back all of those gains? Rarely. So you can't look back to 2008 to tell you anything about what the next downturn is going to look like. It was truly a house of cards in that buyers didn't have their own money. They had no skin in the game, and they didn't qualify for the loan to begin with. The best example that I like to give of what happened in 2008 is the first house that I flipped in late 2008. We bought it in October of 2008 for $265,000. The gentleman that we bought it from, we didn't buy it from him. We bought it at the courthouse steps. We had to evict him, and he was arguing with us when we first showed up that he had a lawyer. The lawyer's fighting it. He's going to get his house back. And I asked him, so what's your house payment? It was $5,900 a month. So, okay, that's interesting. How much money did you put down? Put no money down. What's your interest rate? I was like 6.5% variable. So we go through it. I said, you see the house across the street? Is that one nicer than yours? Yeah, it's a nice house. It's nicer than ours. I said, you can rent that for $2,000 a month. Why are you trying to stay in this house at almost $6,000 a month when you can rent that for $2,000? So it was the rational decision for the vast majority of owners that got in late in the game to just walk away. They were only risking their credit. 180-degree opposite in this current market. People have put real money in. They actually qualify for the loan. And it's been shown, like prior to the downturn in 2008, one of the big stories that people like to tell is home prices have never decreased year over year nationally. You're like, okay, cool. That's nationally. Southern California, they had decreased year over year many times. It's a cyclical market. Now we have many more cyclical markets around the country than we have. So it's reasonable to expect that home prices are going to go down. The question becomes when and from what level. So the one thing that I always like to look at is a long-term trend of home prices. Let's not say, again, something that people have been really fond of saying is, hey, oh my God, home prices are too high. They're higher than they were in 2008 when we had the greatest crash ever. It's not relevant. You look at the long-term trend because incomes go up, interest rates go down, and you look at what real home prices have done over time. We are right on trend. But if we have a couple of years of 10% appreciation on top of where the long-term trend says, we're going to be 20% above trend, and we'll correct. But say a correction takes a year or two, that trend keeps going up. So to correct down to that trend, maybe it's a 10 or a 12 or a 14% downturn. So when people are asking, is the market going to take a dip in the next 3 to 5 years? Should I wait for the dip? No, because it's going to dip from a higher level. It will dip. We will have it. I would think somewhere in that 3 to 5 year time horizon is pretty reasonable. But I also would say we're not dipping from the current values. So if you can get an offer accepted and you can take advantage of current interest rates, you're better off getting into the market now. You know, Jeb, the thing you and I have been talking about 2 weeks ago, 3 weeks ago here and in borrower conversations, buyer conversations, we're saying, no, don't wait. There's nothing fundamentally that makes it better for you later in the year, next year. Now, I don't know. It's really hard to advise people. It's a tough market to be out there writing offers as a first-time buyer without a huge down payment.
No, couldn't agree more. I mean, you know, the example you gave there about, you know, the rational approach to saving a house for $5,900 a month or going and renting one for $2,000 a month is honestly like one of the best explanations of that time, because, and it's one that I never even bring up because quite frankly, I didn't even think about it. But when you said it, it did. It made a lot of sense. I mean, I knew multiple people, a lot of them in the mortgage business that had overextended themselves, but many people just across the board at that time. And, you know, adjustable rates at that time, you know, interest only, those all came due, right? They were short term. They came due at one point, and and at the time, values had dropped, and it just made no sense to try to keep a property at that point, especially when you had little skin in the game. So people were willing to walk away, and we've talked about, you know, this in length many times about, you know, how different it was, and again, I have that conversation a lot just because, you know, that seems to be everybody's go-to. Well, prices are higher than they were in 2008. Well, that's right. But in 2008, they were also higher than they were in 1950, right? I mean, doesn't mean we're going to fall back down to prices in 1950. Things go up over time. It costs more money. Land goes up. I mean, the whole idea. So anybody that thinks that prices can't continue past the recent high where things fell, you're going about it the wrong way.
Think about this, Jeb. I don't want to take you off track, but that same house, I don't know if I closed the loop. We bought it for $265. The gentleman had paid $685 for the house less than 2 years before, a little more than 2 years before. But to your point, what you were saying, we bought it for $265, which was a steal, and we resold it for $400 when it was fixed up. But that house, that's 2008. In 2000, that house was a $200,000 house. So depending on where you bought, they don't go back to where the prices were in the 1950s or the 1960s. They go back to a rational level, and that was irrational. The number that we sold it at 400 was kind of what the real number, just like the 685 number he paid was a crazy number. We may look back and see these numbers being crazy. I think I told you, Jeb, I was in a mastermind with about 5 agents last Friday, and one of them was a big producing agent in the Bay Area. And he said they had a weird blip like this in early 2019 where they were having home prices go up 5-10% month over month in the first quarter of the year. And then for the rest of the year, they had a little dip, about 5%. And then it just continued normal. But if you had looked at the trend, it kind of stayed on trend. It's just they had this blip where it spiked and then it corrected for a little bit and kept going. So I wouldn't say we wouldn't have that, but I just can't come up with a scenario where with as many buyers out there chasing properties and as few sellers as we have, that the supply demand dynamics would support a drop in prices.
No, but what I will tell you from my end, being out there, obviously I deal with the sellers and that side because you're dealing only on the loan side. And this is going to be a question that's going to relate to Bassam's question here as well. And it's also going to be along Tim's questions too, just asking about prices and that sort of thing. What I'm seeing right now in the market is people that, so things have gone up considerably, right? And I'm talking about SoCal, but I have friends that sell in Austin. I have friends that sell in Boise. I have friends that basically sell all over the country because I'm part of mastermind groups as well. And it's all a similar story. So when I say real estate, yes, I'm talking local, but I can talk from a broader view just because I'm having these conversations. And so, what I'm seeing here locally right now is clients of mine that we were originally talking about listing in, say, May or June, have two conversations today. In fact, we have moved both of those listings up to March, maybe April 1st, but one is going to be middle of March. One is going to be April 1st. Why are we moving them up? A little bit of the unknown, right? Not that we think there's going to be some big crash, some big dip, nothing like that. But what we do know, just like when we talked about interest rates 6 months ago, and people would ask, well, should I refinance now or should I wait? Does it make sense now? And for my clients, it makes sense now. Could they potentially get 1% or 2% more if they wait a month or two? Sure, maybe. Could they get 1% or 2% less? Potentially, not likely, but they're okay with the numbers that we think right now. There's not a lot of competition out there. Buyer demand is still high. Interest rates are still relatively low. So they're in a position where they're going to see property like that. I mean, they're going to put their property on the market and it's going to come to market. I believe if I'm personally having my clients think along those lines, chances are you've got a lot more people out there that are looking at what's happening in the market and thinking the same type of thoughts. And not to say the inventory is going to pick up considerably to a point where the market changes, but I think you're going to see more property come to the market, in the next, I would say 6 to 8 weeks, which could ease a little bit of this pressure along with rising rates over the last 3-4 weeks. That could be enough to back that buyer demand off just a tad to slow this housing market down enough to keep the steam rolling. Now, Bassam asked the question earlier, will prices go down in Orange County or SoCal or what have you? My guess is I don't think you're going to see prices go down, but what I think you might see is that if you get a little bit more inventory coming to the market, you might see things not go as crazy above the asking price, right? Because what we're seeing right now is things that are priced fair market value-ish are still selling for 5% more. I mean, it's crazy what some of these things we're seeing, and it's not healthy. It's not good. It's not good for agents. It's not good for buyers. I don't like it as a real estate agent. Everybody's like, hey, Jeb, you must just be loving this. No, it's scary. I mean, this is my livelihood, right? I mean, not YouTube, but selling real estate. I mean, I want my clients to be happy. I mean, my business is mostly relational, right? And my job is to do a good job for my clients. And so I want to be able to give good advice in these cases. And people asking, well, should I wait or should I buy? It's hard to say, right? I mean, I don't think prices are going to come down, but I don't like what I see. And so, a long way of getting to, if you have a longer time horizon, as I've said thousands of times on videos, I think you're going to be fine, right? Because payments are still low. Just don't extend yourself and you're probably in a good position. But, if you're one of these people going so crazy far above the asking price just to chase it, my gut tells me that you should just kind of relax a little bit and just take a little breather and just see what the next couple of months holds, because I think you might see some more property. So,
Hey, Jeb, I don't know where you kind of wanted to go, if there's any questions, but something interesting that I've been fighting with over the last day. Have a client, another agent that I work with, and she sells a lot of houses, but she flips houses. So she has a beautiful brand new flip on the market, listed it at like 800. Multiple offers, went for 827.5. We knew it was going to be difficult on the appraisal. Appraisal comes in absurdly low at 770. So I've been fighting with the appraisal management company. So for those of you at home that don't know what in the heck an appraisal management company is, back in the day, we had appraisers that we worked with. We need an appraisal, we call an appraiser that we trust and send them out. There were problems with that. People were buying off appraisers, bad values and that stuff. So now we have to go through
2008, by the way.
So now we have to go through an appraisal management company. And this is the first rapidly accelerating market we've seen since 2008, when you don't have a trusted professional. And I'm not saying someone that will push a value for you, but someone that will be reasonable and do what works within the appraisal guidelines. So on this one, we have an appraiser telling us that the most valid comp, due to the location, this house happens to back to a freeway, that the most valid comp for this is the one comp in the last 6 months that also backs to the freeway. So it sold in October. Our market is up, 8-10% since then. He did a $28,000 price adjustment for it. But I've been going through with the QC department at the appraisal management company, and I got a very interesting email back from them on this. It says, the truth of the matter is the GSEs, which the GSEs are the government-sponsored enterprises, Fannie Mae and Freddie Mac. The GSEs have the appraisal system engineered to where it will not keep up in rapidly appreciating markets. I believe it's set up that way on purpose. The GSEs want a rapidly appreciating market to be fueled with equity dollars, not loan dollars. It's a hedge against a crash. The unfortunate consequence is that, and this is an appraiser speaking, so excuse the language, that marginally capable buyers are forced out of the market. There's really nothing you or I can do about that. The system is designed to limit irrational exuberance to those that are willing to back it up with a large equity stake. And in this case, these borrowers, they are only a 5% down borrower. They're going to have $30,000 in reserves when they close. They have 800 credit scores. Debt to income ratio is really low. They're literally the best borrower the GSE could make a loan to. But there's some truth in what he said, in that when a market gets ahead of itself, the appraisals are based off of three things. They give a value on replacement costs. So if it burns down, what does it take to rebuild it? Income approach, which what can you generate in rents? And those are generally, they're in the report, but they're given no weight in a residential appraisal. All they're doing is the comparable sales approach. This appraiser chose to go out and say, the most important thing about this house is it backs to a freeway. So the 5 comps that supported something near our value were given far less weight than the one that backed to the freeway. And it's just a weird consequence of a crazy market that an appraiser can go out there. I cannot argue with him. I don't have better comps to provide. I'm saying you're using the right comps. You're putting the most weight on this one and adjusting them all to match that. So my whole point in even bringing that up is a lot of people that join us here, we don't have the people, for the most part, that have 30, 40, 50% down. They're buying their first home with a 3.5% down FHA, a 5% down conventional, a VA loan. And those people don't have a chance. The only one that is winning the bids right now is the guy with 15, 20, 40, 50% down. And you say, I'll waive the appraisal contingency. So it's frustrating for you guys. It's frustrating for us. But to a degree, it's keeping a little bit of a lid on price appreciation.
No, yeah, it's and like you said, that statement is, I mean, as much as it's frustrating to be on the other side of it. Like, I mean, there's some truth to it probably, and probably a good thing that, I mean, if that is truly the case, I mean, to slow it just a bit. So let's jump on a question here. So Nick Family's asking, would you recommend selling a home in Phoenix, Arizona? So I know there's a lot of great agents in Phoenix. In fact, I know a handful, and that market is bonkers, like SoCal. So it's one of those markets that it's good to be a seller. The question is, should you sell? I mean, I can't answer that for you, but I could tell you, if you were thinking of selling in the next, 6-8 months, yeah, I mean, it's probably as good a time as you're going. I mean, your market you've got some months here coming up that it's going to be unseasonably hot, miserable, while we're basking in 75-degree weather here in Southern California. That could slow sales a little bit. I don't know how it's going to impact the market out there. It might ease it a little bit. I would imagine that, spring is probably your hot market. So, talk to a professional in that market, get some advice and see what they can do. I mean, obviously I'm not in that market, but I know it's a good time to be a seller, kind of regardless of where you are.
The $1 million question still remains, Jeb, is sell and do what? Are you going to sell and buy? Because
absolutely.
I would just be very cautious if you have to wade into the selling market on top of all that.
No, funny. One of the clients I met with today that was listing later, that we're listing it now, we were having a conversation there, and she goes that her friends had sold a house in their neighborhood in 2017, and their idea was that prices were high. We're going to sell. So we're going to list theirs at $949. It'll probably sell for $1 million. So $949 is going to be the list price. Their friends sold for, I think they said somewhere in the eights 2 years ago. And their idea was that they were going to buy and wait for a pullback and then buy something else. It's gone up 100 and something thousand since they sold, and we're waiting for that pullback. So, those are examples that happen everywhere. Clearly, Josh and I don't have a crystal ball of what's going to happen, but I've seen this enough times to know that the consensus out there isn't always the right decision. There's that one quote that we always talk about is the market can remain irrational longer than you can stay solvent, and in this case, the solvency part isn't really doesn't play in, but it's the irrational part. It can stay irrational a lot longer than most people think. I mean, look at the Toronto market, for example. Canada, they've been dealing with this crap for twice as long as we have, and their market's going nowhere, and those properties are selling, I mean, well above what we're seeing here in the United States with regards to appreciation. So if we saw something like Canada, this could go on for 3, 4, 5 more years. Who even knows? And then their market's not even slowing down. So who's to say what's going to happen there?
The biggest thing that I would say, kind of about what you just said there, Jeb, is almost, I don't know that I've ever heard a story of a homeowner or home buyer or home seller who successfully timed the market. Like they had some special insight and they knew. It generally is emotional. So that they sold at 800, those folks. They probably bought at 300 or 400 or 500. And looking back, 800 seems crazy. Well, when you're not in the market, you don't know the fundamentals. Most people don't work in financial industries and look at what real price gains are in terms of accounting for inflation, accounting for wage growth, that type of stuff, interest rates. It's just, I don't try to time the market. Think in terms of, what is my life cycle? When am I ready to buy? Do we have a kid coming? Do we need to get out of an apartment? Did I just get married? Any number of things. Did we just downsize? Did the kids just go off to college? Make sure that the decisions are based off of the fundamentals in your life. Over time, like honestly, when we talk about any of this, the only people that it really matters for are first-time buyers making an entry point. You know who got burned in 2007, 2008? The people who bought their first home in 2006. Even in 2005, if you
Trust me, I know.
If you bought reasonably smart in 2005, you had some appreciation. You had a little bit of wiggle room in there. It was the people that came in late with no money down and just got slammed. So think in terms of, what are the underlying market fundamentals? This is supply and demand driven. It's interest rate driven. We've talked about this all last year. What's going to happen with interest rates? I think rates are going to go lower. Don't pay a bunch of points for your loan. If we talk today, rates are higher. Rates could go higher still. They're not going back to 4% anytime soon. That literally cannot happen. And we are likely to see rates lower going forward. Is that 6 months from now? Is it 36 months from now? I'm not sure. But, when you were talking, I ran some numbers real quick. For us here in the California market, your best case for an entry-level buyer in SoCal is $700,000, unless you're way out in the Inland Empire. At that, if you have a 0.5% increase like we've seen in the last 3-4 weeks, it's $189 a month. Doesn't knock most buyers out of the market, but it's not fun. It's like you just signed on for a 30-year car payment of $189 a month. But versus paying 2 points to get the rate from a month ago. So on that $700,000 loan, do I pay $14,000 and save the $189 a month? No, we don't, because everything that's going on, all of the government spending and borrowing is deflationary long term. The demographics of the United States is deflationary long term. It will lead to lower interest rates. So an interesting thing, when you talk about a bubble, it's only a bubble if it actually bursts. We have an asset bubble in equities. We have an asset bubble in home prices. But if the fuel for the fire never goes away, the bubble never bursts. Because again, we've talked about this 1,000 times. People don't buy a home price, they buy a home payment.
Right.
Just like the car dealership. So if the payment stays reasonable and enough people can afford it, the prices will stay high. I still believe we are going to see 30-year fixed rates in the ones, they're not 1%, but 1.5, 1.75, 1.875, under 2% before we're done. There is a floor on how low rates can go. At a certain point, lenders couldn't profit. So even if money can be borrowed by institutions at 0%, they have to have a markup on that money. So I don't know where it is. Is it 1%? Is it 1.5? But we're going to find out.
No, good stuff. And I'll just leave this and we'll move on. We'll start getting some questions. I've been a real estate agent since 2002. I bought my most recent house in 2012, December. I'm in the market, what have you. Bought a house because my wife and I wanted to buy a house. More my wife wanted to buy a house, and I went along with it and didn't really think much about the market. Nor did I think that it would jump literally 3 to 5% after I purchased that house within 6 months. And that's what happened. I mean, I'm in the market day in and day out, helping buyers, helping sellers. And, the market changed within 3 months. I mean, considerably, right? Just inventory got to this point, started, not like we're seeing now, but for that market, it decreased and we saw this big jump. And so take somebody like me, I consider myself an expert. I couldn't time the market. Fortunately, I got the benefit of what happened, but there's a lot of people out there that aren't professionals, that aren't experts trying to time this thing. It's a losing game. So, and I'm not, it could be either way, whether you're on the buying side and or the selling side. It's not as easy as, watching the news, watching CNBC, and making a decision. It doesn't work like that, right? It's an emotional process, but it has to do with fundamentals of supply and demand. And right now they point towards a stronger housing market. So,
and back to my point, Jeb, what happened then? I mean, you could have continued renting at that time. There was no downside in renting. Right. You got married, you had a kid.
Right.
It just wasn't going to work to keep renting. I mean, you could rent a house, but then it gets prohibitively more expensive. So it made sense for you guys and it worked out well. You didn't have to worry about trying to time the market. It just was the right time in life for you and your family to buy a house.
Right. Yeah. I wasn't concerned where things were going. I mean, it was more of, I was buying because I needed to buy. That's how you need to think about this whole thing. Don't worry so much about, it's not a stock, what it's going to be worth in, 6 months or whatever. Just think about what you need in your life and find something that suits that. And, think along the longer time horizons and you'll be fine. So, we got people, commenting here. Nick Family's asking, no, he asked later on if we're licensed in Arizona. Not licensed in Arizona, but if you need somebody there, reach out on the real estate side and or the loan side. We can help you out.
Yeah, we got great people on both sides of that.
All right. Here we go. So we'll start with this one. Do you think a big offload of investor-owned properties would shift home price value prices? So maybe talking about shadow inventory, if you will, the famous shadow inventory.
That's never come to market in 12 years, but
exactly.
It's gonna come someday.
Yeah, someday it's all going to just bring the housing market down. So what are your thoughts on investor offloads? We've talked about this. In short, it would take so much property. Think here in Orange County, a balanced market, not in favor of sellers and or buyers. Home prices aren't really going down. They're stabilized. I would say is somewhere between 6 and 8 months of supply. Right now, we're less than 2 months supply of homes, say 1.9 months or so. So think and that's 20. I mean, right now we have, I think 20, last time I looked, like 2,600 homes on the market. Maybe it's changed a little bit. So say you added 2,600 homes to the market. That only takes you up to 4 months. And then you got to do that again and do that again to even get to a point where it's somewhat balanced. So, Southern California, not likely to see anything crazy happen with regards to prices coming down. Could it even the market a little bit if a lot came? Sure, it could. I don't know where it's going to come from. I mean, if you're counting on forbearance, you're counting on foreclosures, you aren't going to see any of that in 2021, in my opinion.
There's a couple things here with this one. So to a non-investor, you might look and go, well, I'm an investor. You bought a house for $400,000. It's worth $850. You'd be tempting to sell it. It's not the way an investor thinks. An investor says, what am I going to do with that money? Where Absolutely. Am I going to put it?
They don't want to pay taxes on it.
Don't want to get taxed. For the most part, I'm not saying real estate investors don't have equities, but the people I know that have large real estate portfolios, that's their investment. They understand it, they know it, they stay in it. You may be, again, thinking in terms of the large hedge funds and asset managers that bought up a lot of distressed properties and have held them in their rental inventory. Again, those yields are so good on their rents from the properties that were bought in 2010, 11, 12. Why would they sell? Those of you that listen here, you know that I will tell you that 80% of the people in our industry on the finance side are not good with numbers. They're not good with sales. They're not good with service. They're just not good. But someone in the top 20%, that I would say is actually in the top 1%, one of the smartest dudes I know here in Orange County, super connected. When COVID jumped off last year, he was telling me and my partner, said, hey, I'm pretty connected over at Fannie and Freddie, and they're telling all these hedge funds that own big portfolios of rentals, they got to dump them. It's coming. That shadow inventory is finally coming. They're going to put these into the market. And you're like, did it? No, it didn't. I don't know. It's the biggest urban legend ever that there's a bunch of foreclosures off books that banks own or that hedge funds bought and they're going to dump them. There's really, when you look at other places to invest besides real estate, there's not a great place to park the money. When you look at the tax hit of selling that appreciated asset, and then where are you going to put the funds to work? When you look at the yields they're getting, some of these homes, an investor I know in the Inland Empire, he sold one of the few successful market timers, but he also does greater research on the market than anyone. I mean, he's got reams of notebooks of data on what makes markets move. He sold everything in 2005, 2006. He primarily was in like San Bernardino, Moreno Valley, Riverside, that area. The homes that he sold for $400,000, he went back and bought them for $90,000 and did like a $30,000, $40,000 rehab and rode those up to like 350, 400, 450 again now. Why would that guy sell? He owes $90,000 on those properties. He was getting 100% financing because he had access to funds as an investor. Why would that person sell? Where is he going to put the money? You could say maybe he sells 30 of those and you have, 10 or $12 million that you could then go and put into a big apartment building. Maybe, but it's going back into real estate. Those guys invest in real estate. And strangely, that guy actually is selling some of those properties. He's buying homes free and clear in Florida. He just likes the math better in terms of yield, and he's getting older. So you just have to understand the investor mindset and what they're thinking. The money has to go somewhere, unless they're just saying, hey, I'm going to cash it out and go nuts my last 4 or 5 years of life here.
So I'm confused. So these people aren't selling their property and buying Bitcoin?
No.
Oh my God. What am I thinking? All right. So you'll does bit nervous about the spike in 30-year rates. Got a property under contract. So congratulations on one side. Maybe the rate's a little bit higher. Chances are you might have an opportunity to refinance in coming months. Might not be immediate, but chances are you will. And we'll talk about rates here in a little bit. So
here, yeah, and there's also it's the same question here. Jeremy has the same question. Building. So yeah, let's circle back and definitely go in depth.
Yeah, we're going to talk about rates, but I want to get through some questions here before we do, because it tends to be one of the most asked questions. Do you think Biden's housing tax credit will create artificial demand and extend this bubble. So we've talked about this a number of times. At this point, right, there is no housing credit. It was something that he proposed while he was running for office, probably to get elected. Could it ever come to light? It could. Chances are it's not going to anytime soon. It would kill the housing market even more. I mean, it would just create so much more demand that doesn't need to be there, and fuel things well above where they need to be. I've heard people say maybe he's saving that if things did slow down, he could use that to help keep this thing running. Maybe. I mean, that's a realistic possibility. But understand that, again, it's not even a bill yet. It would have to be a bill, then it would have to be voted on. And then, this is months and months, years potentially out.
Think about the reality of politics, Jeb. 2 weeks ago, they were certain that there was going to be a $15 minimum wage. That didn't make it through this bill. Right. They did not want to limit the $1,400 nearly as much as they ended up. Yep. Today it got pared down to single borrowers or single Americans at 80,000 or below. This is something, there's a big cost to it. So it sounds crazy. We talk about politicians love to spend money and never put the brakes on anything. But when the rubber hits the road, there are very thin margins. The Democrats have a majority in the House. They have a virtual majority in the Senate. But even at that, you have to have all of your ducks in a row. Every Democrat has to agree on it. And when you're talking about spending money like that tax credit, no one is ever going to pass a homebuyer tax credit in the current market. With a hot market, it's easy cover for a politician in a hot market to say, I'm not going to do this to my people. I've got first-time buyers trying to buy, and this is going to actually make it harder for them to buy because there'll be more buyers out in the market.
Oh, good. Al Bundy is saying, I saw a lender saying they are seeing more for sale by owners. How about in Orange County, LA market? So I haven't seen a lot of for sale by owners personally. There's not really a way to track for sale by owners. So it's really hard for us as real estate agents to find for sale by owners. They're not in the MLS. I don't look at the Zillows and the Redfins and all of those. So my guess is you're probably right. I mean, you're probably seeing more of these right now because sellers don't believe that they need real estate agents in a market where it's hot like this. But I will always say that this is where people get burned on both sides, whether it's buyers and or the people selling their homes, because there's a lack of due diligence done when people try to sell their own property. There's many steps that are skipped, and a lot of people can be hurt in these situations. So, if you're one of those people out there looking for sale by owners, fantastic. I would try to get an agent involved on the buyer side to help you out so that you can do due diligence and make sure things are done correctly. And if you're one of those sellers thinking that you could sell your own property, I would tell you that it's not as easy as you think. There's a lot of steps into it, and I could talk about it in more detail, but I'm not going to bore the people here by telling you that you need a real estate agent.
Hey, Jeb, the thing that I would say, so we, as a lender, we end up doing financing on 3, 4, 5 for sale by owner properties every year. And I could say, to put it kindly, it is constantly a shit show. And rarely, I wouldn't even say rarely, never does that seller provide all of the disclosures that they are required by law in California. California is a heavy disclosure state, and not having an agent doesn't relieve you of that. So you don't care. I mean, if this is a crazy market and you were able to get the offer accepted by going on a for sale by owner, you're going to do what you have to do, but you're not going to get the disclosures you need. The transaction is not going to be professionally managed. So at the end of the day, for buyer or seller, have I seen those work out well? Yes, I have. But for the most part, it's a mess.
No, and in a market like this, when you want to try to, and when you got buyers putting well above and beyond the asking price, waiving appraisals, doing all kinds of crazy stuff, if you think as a seller you want to try to negotiate that, go for it. I mean, all the power to you. So, Echo Super 4 $20 super sticker. Thank you very much. That was very nice of you. Grateful for that. I don't know if you have a question here, but if you do, let me know. I'm happy to move you up the list, my friend.
I'm gonna make you buy beer when we're done, Jeb.
We should buy it right now. Oh my goodness. Let's see here.
How about you just pop up Eric
Here we go.
Wang here, and let's
No,
just
I got
actually.
one. I got one. Well, let's go with this one. I popped this one up a minute ago falsely, then we'll go with Eric.
Okay.
Selling my house and buying another. Should I use some of my capital gains to pay off cars? So, selling your house, buying another. So I'm assuming by capital gains, that means that you sold a primary, and you know, were able to take some of that tax-free money, keep it. You're asking, should you use that to pay off your cars? You know, that's a question probably for Josh more than myself, but I mean, does it affect your ability to qualify? If it does, potentially. You know, what are the interest rates on those cars? I mean, if they're, you know, super low, I mean, maybe not. I mean, it just really, I mean, it depends on your financial position. Like, what are you going to do with that money? There's a lot of places right now that you can probably stick that money and make more money on it, depending on how much it is, than what you're going to, you know, than the interest rate on your car loans, unless you got some crazy car loan. So I'm more about leverage in a lot of ways, because I feel like that's how you can really make wealth. But you can't be dumb about it either. So, you know, I think there's more there that needs to be known. But anything you want to add to that?
I like life being simple, so having one thing to look at versus multiple. When I redid my loan last year, we paid off a little car loan, and just took that extra payment and put it on the house, so an extra principal payment every month. But a couple of things that you want to look at here is the additional down payment going to make you look better in this market as a buyer? Would it be more valuable to you there? Like Jeb said, do you need to pay them off to qualify for what you want to qualify for? And it's always important to remember that if you don't put additional amounts towards principal every month to pay down that portion that would be allocated to the car payments, what you're effectively doing is taking a 2, 3, 4, 5-year car payment and making it into a 30-year car payment. Makes it much lower, so your cash flow is better on a monthly basis, but it stretches it out unless you use that savings to just make an additional principal payment and shorten the term of your loan. We always like to run those numbers for our clients so we could do that in a side-by-side comparison and show you what that looks like so you can make an educated decision on it. But always just be careful. And I always like to ask my clients, are you conservative? Are you a risk taker? And what are you likely to do with that money? Are you likely to go, hey, I don't have a car payment, and then go buy a new car in 6 months because you can, because you have a nice trade-in? All the things you want to consider.
No, absolutely. And Echo just said they wanted to thank us for that. So we want to thank you too. Appreciate it. If you're watching, do us a favor, hit that like button. Helps more people see the content and helps us educate more buyers and sellers, which is the goal here. And if you aren't subscribed, hit that as well. So Eric had a question, or Eric, you had popped something up. You want to hit that, Josh? And
yeah, just Eric, we hear enough about how hard it is. Eric got an offer accepted today. So
that's
again,
awesome.
brutal for everyone. Super stoked that you were able to do that. And he says down here he's a first-time buyer and super excited, and rightfully so. So it's a crazy market. Congratulations on getting in, and it's nice to hear good stories instead of everyone here. I'm not saying people are complaining. They're rightfully complaining. It's a crazy market. So we hear a lot about people losing out on multiple properties. It's nice to hear someone getting one.
No, absolutely. So Otto MC says quarantine got the quarantine got people realizing they want backyards and bigger living space and asking it as a question. And the answer is absolutely. You know, migration patterns, you know, are part of it. You got people working from home. You got people that, you know, buying second homes in resort areas. You've got people that have been stuck with their kids, their 3 kids, their wife, their 3 kids and their wife, their 3 kids and their wife.
Do you know someone with 3 children, 3 boys, 3 young boys under 10 and a wife?
3 boys, 8, 6, and 2 in a house for months right there for a while. And yeah, it has you thinking you need more space, bigger yard, all of that. And so that has definitely played a part. But you also have people that want more space because now kids, you know, aren't able to get that property. Now maybe they're not going to college because college is virtual or whatever, and they're working from home or living from home. And so now parents need bigger spots. There's a lot of things that are playing into this. I mean, I had clients buy a house last year here because they were empty nesters. And guess what? Soon as they purchased, 2 months later, everybody came to live back at home because of quarantine. And then college got canceled. And now they're thinking, what do we do? Like, now we need to buy again. We need to buy something bigger because we're tired of all of these people being around us. And so, yeah, that is definitely playing a part in it. That low interest rates, there's a lot playing into this. And then you've got, when there's not a lot of something and everybody wants it, we're going to say supply, not a lot of it. Everybody wants it. Demand, people are willing to do crazy things in order to get the things they want, especially when they feel like they're missing out, that FOMO. And so here we are, right? We're having these conversations because there's a lot of people that want to buy and there's not a lot of inventory to do it. Let's see here. So here we go. Here's a good one. What do you think about home builders in the next few months regarding building material supply, Josh?
The building materials of just they're having their input costs go up. They're definitely,
and or even being able to get it.
Yeah. The market's pretty adaptable in the long run. In the short run, if there's no lumber or the price of lumber doubles, it's going to get passed on to consumers. It's going to make it more difficult for them. We're looking at possibly redoing our backyard and doing a pool, and just for pool contractors. That used to be you call the day before, hey, I need this much concrete delivered at 7 a.m. Now it's like, no, you let them know a week or two in advance, and hopefully they don't run out on the day that you're lined up for. So every type of material, copper, lumber, concrete, all of it is there. The costs are going up. Just a reality, crazy market.
Yeah, and I don't think it's going to change anytime soon, right? I mean, there, a lot of, believe it or not, a lot of the lumber and the wood and stuff now comes from China and some of these other places. And if you live off, the coast of Southern California, like where we live, there are boats just lined up. I mean, if you look at the tankers that are out there, not tankers, but the what are they called?
I don't remember what they're called, but I saw them. It alarmed me when I drove down the street.
Basically, the shipping container boats. Yeah, like those guys. There are hundreds of these guys off the coast of California right now. And, if you're going into the store to buy furniture or buy appliances or buy anything related to homes, you're going to find out that you're 4-6 months out in some of these cases just because of how back ordered these things are. And they can't get them in because these boats are sitting off the coast waiting to deliver what's been ordered months ago. And it's because the docks, the ports, they don't have the workers due to COVID and all of these restrictions that have been put in place to actually to be able to bring these materials on site. And so that building materials are in there as well. And when you think of wood, you think of all these things, you think, well, just go cut down trees and you're going to have some wood and you'll be able to build houses. Not that easy, because a lot of this stuff comes from places that are restrictive in getting it here at the moment. So I don't think that's going to change anytime soon. Some thank yous. So appreciate you guys always tuning in. I saw one up here from Sharon as well. So let's go down here. So Al has a question. What are the FHA home condition requirements that sellers have to know when considering an FHA offer? Like problems that FHA appraisers call out. And then he also asked a question about VA. So I'll let you take that one. It's pretty simple, not really a lot that's going on there, but
yeah, for the most part, it's health and safety issues. And the biggest health and safety issue we see that they are picky about and will call out is chipping paint on pre-1978 homes. If your home was built after 1978 when they outlawed lead paint, you don't have to worry about it. But pre-1978, if there is any sign of chipping paint, you will have to do it. Anything that can be a health and safety issue, like broken gates that could allow someone to get into a backyard and cause a problem. Just silly little things. But for most people, when they're preparing their home to put it on the market, there's no health and safety issues. And VA is not much different. They're looking for the health and safety issues.
And honestly, not really seeing a lot of these days, right? I mean, it's, most listing agents know that if they're trying to do something FHA or whatever, they know what needs to be done prior to these guys going out there. So we're not really seeing a lot of issues. So Sharon had a 13% interest rate before you were born almost. Yeah, probably. Yeah, possibly. Let's see here. I'm seeing houses in rural Illinois that have been on the market for 50 plus days. And some of those are listed as price recently lowered. I'm hopeful that I can pay asking price. So some of the rural areas you might see, chances are you're going to see markets slow down in rural markets before you see them slow down in more metropolitan, suburban type areas. Just how it works, right? Because what happens is people start in the suburban areas, and when there's no more property there, they slowly move out until they get to those rural areas. Not always the case. Sometimes you have people that just want to move to the country and live by themselves and not be bothered, or for whatever reason. So it's not always what happens, but typically when people get priced out of other areas, they move out and then it works its way back in the same way. So maybe in your market, depending on where you are, but I also understand your market is probably there's some weather related things that go on in Illinois. Maybe as the market starts to heat up again, you start to see the market pick up, which I would imagine would happen as things warm up in your market.
An important number to look at with that is net migration, and it's easy to see on the state level, at least year over year. So an example, we've all talked about how the Idaho market is just nuts right now. Their net migration was positive 40%. So they had 40% more people moving into the state than moving out. It was 70% moving in, 30% moving out. So that net migration is a big impact. And the only reason why I say that, if you're in a more rural area, there's not as many jobs, not a robust economy. So there's just not as many people moving to those areas. And we've talked about that time and time again, everything is supply and demand. So if the demand isn't great, even though it could be a wonderful place to live, if it's not a good place to raise a family, start a career, all that fun stuff, you're going to see lower demand. And as long as the supply demand dynamic is in your favor, you can negotiate a good price. Unfortunately, most of the country, we are the exact opposite.
All right. So we got some stuff talking about rates here. We've been on 50 something minutes, got 250 people watching this. Let's talk about interest rates here for a moment. So Tyler also asked a question about rates. How long does it typically take for a change in interest rates to begin to change prices of houses? 6 to 12 months or longer. So let's talk about rates, Josh. So what we've seen last 3 weeks, rates have creeped up somewhere around 0.5%, depending on certain factors or what have you. That was a couple of days ago when I talked about that. What are you seeing? What are your thoughts? I mean, I know long-term horizon, whether it's a year, 2 years, maybe we don't really know, but you do think rates will come back down. What are you seeing? Let's talk the next 6 months. What do you see in the next 6 months? And again, not holding you to anything, but just based on what your feeling is at the moment.
So short-term crystal balls are difficult. And what I will say, I've told you guys before, I pay a lot of money to some really smart people that follow this closely. The guy who's far and away the most tuned into technical analysis, which is our best indicator over shorter time horizons like that. He's also quite confident long-term that interest rates are going lower. But he uses something, I've bored you guys with the candlestick charts here before, but he actually uses wave theory to look out further into the future. And he thinks for the time being, we've put in the worst levels. We could get a little bit worse, but say we're within an eighth of the worst levels of rates.
And what are those rates, Josh? Just throw something out there. Best, I mean, not getting into minutia of it.
Across the board, we're up 0.5% in the last 3 to 4 weeks. So the FHA that was 2.25, the FHA VA that was 2.25 is 2.75-ish now. The conventional loan that was 2.75 is 3.25. So those are good, reasonable numbers. If you're exceptionally well qualified or a larger loan, you might get a little lower than that. But for the most part, 2.75 on well qualified borrowers for government loans with no points and no fees, and 3.25 for a conventional loan, right in that range.
Okay.
So what do we look at? He's saying we should be within an eighth of the worst of rates. So maybe 3 3/8, maybe 3.5 at the worst. And he thinks we'll get 1/4 to 3/8 of it back here. So back into the high 2s for conventional loans, mid 2s for an FHA. It was refreshing. I had a conversation with a buyer this afternoon that qualified him 3 weeks ago. It's one of Billy's buyers, and we talked to him 3 weeks ago when rates were much better, and we went through it, and he goes, well, I mean, that's still a really good rate. And that's, unfortunately, most people don't look at it that way. They scream and cuss and yell, and why didn't I get the 2.5% interest rate? Rates are still very good. If you go back, Jeb, in November and December, we were having our look forward and forecast, what do we expect? Right. And said, rates probably similar, and worst case, somewhere in that 3.25, maybe worst case 3.5. I still would hold to that. Everyone wants to know why. Why are rates going higher? And it's inflation fears, And it's funny, I asked the gentleman that I told you was really good at technical analysis. I asked him this afternoon, I said, hey, you're expecting a little recovery of 1/4 to 3/8%. I said, does it worry you that COVID broke out in March of last year? So when we got March GDP figures, April GDP figures, May GDP figures, and looking at inflation, GDP was super low. Inflation figures were really low. So now when we get CPI, the consumer price index, when we get the producer price index, now we're going from these really low levels last year. So no matter what, they're going to be very high and hot when they come out over the next couple of months on a year-over-year basis. I said, is that going to spook the markets? And he says, I would lean much more towards the technicals. I think the spooking is already here as people see that despite the vaccinations, despite the economy opening back up, it's not going to be just floodgates open and the economy goes back to normal, which is kind of what everyone is thinking. It would actually be good. It would be great. It would be great for everyone if everyone could go back and snap their fingers and have their economic life from January of 2020. It's just not going to happen. It's going to be years before that happens. And the spending that the government had to do, and then the excess spending that they didn't have to do in response to COVID, it's going to have a big drag on the economy going forward, and that will lead to lower interest rates. So let's answer
that question. Like, what does it take for rates to actually impact home prices?
It's a hard question. That's not an easy question. Right. If you look at the correlation between interest rates and home prices go up when interest rates rise, because interest rates are usually going up in a hot economy with inflation, and it takes everything, including home prices, higher. With the manipulated low interest rates that we've had, I don't know that we still have that correlation. I don't know that increasing interest rates would take home prices higher. I also don't know that they would take them lower. And we'll go back to the reason why I say interest rates can't go higher. The government could let mortgage rates go higher. They cannot let treasuries go higher, because that's in essence how they finance the national debt. The national debt is so huge that they can't have rates go up 1%. Now they could say, hey, we're not going to buy mortgage-backed securities and we'll let mortgage rates float higher. Then we would have big problems in the housing market.
They're not going to do that either.
Everyone buying now would be underwater. So the government will not let that happen. They can't let it happen on the Treasury side. They won't let it happen on the mortgage-backed security side. So I don't think it's going to have much of an impact. And then looking out 6 to 12 months, I feel like we're not going to be any higher than we are right now. And so far, it has had no material impact on the market other than slowing down refinances. And for the most part, most of the people who could benefit from refinancing got it done last year.
All right. So good stuff there. Let's see here. We got a couple success stories. Saul's asking, do you guys recommend any reliable websites to look for available houses besides Zillow? I think Redfin is probably the best consumer site out there. It's the prettiest to look at. The best is to get an actual feed from a real estate agent, just because it's the most accurate information. It's coming directly from the input of real estate agents. Everything else is syndicated to these sites. Sometimes there's issues with the syndications, and Zillow now, for example, is a competitor to the real estate industry, and so companies have the ability to no longer syndicate listings to Zillow. And there are companies out there that are doing that because they think that they're a competitor and they don't want to feed the beast, if you will. So if you're using Zillow as your sole website, you're probably missing some properties depending on the area that you're located. So, again, an MLS feed from an agent is probably the best, but I think consumer wise, the prettiest and at the moment is Redfin and seems to be pretty accurate. But I wouldn't rely for either of them on actually providing you with the value of your house.
Well, here, Jeb, that's the second question here. We got another one here. YouTube ready. Can we believe Zillow and Redfin estimates, how the appraisal work in this market? And you already hit the nail on the head. You can't rely on it at all, especially in a market this strong. It's looking at data, at best case, a month or two old, and it relies and weights the algorithm for everything that closed in the last 12 months. So it's always a lagging indicator. When prices are rising rapidly, it's going to give you values too low for the property. And the other way. If we go back in time, back in 2008, 2009, when I was flipping houses, it would give us numbers that were like, no, the prices have dropped. There's no way we're going to get that much for it when we sell.
Well, and another thing is the numbers can be manipulated, and you guys don't see that because you're on the consumer side. But many times, I go to sell your property, it's worth $1 million, for example, right? Or we think it's worth $1 million. Let's say that Zillow thinks it's worth 900,000 for whatever reason. So you think it's 900. I'm telling you $1 million. I go list it at $1 million. Zillow immediately changes their number to whatever I think the property value is, or what I listed at. So, they're manipulated. The same way goes the other direction. Sometimes I'll list them low. And again, I haven't done this recently. Haven't paid too much attention to it, but I've seen where the numbers change based on where I list my property. And so, if that is the sole, it's not the sole factor they're using to price things out, but if it's that easily manipulated, then how reliable is it, right? And right now there's so many factors that play into values that it's a baseline indicator. I wouldn't weight everything on it. I would use it as one of the things that I would think about, but I wouldn't use it as the only thing.
And just, Jeb, from our end, I have to get a quick and dirty value anytime someone calls up and wants to refinance. I'll look at both. We have another paid system called House Canary that it's the same thing. We use HomeBot. It gives us also an automated value, and RPR is another resource.
Right.
When I look at all of those, if 2 or 3 of them agree, we'll kind of settle in on that. But it is amazing to see the disparity that you'll see in a higher priced market like ours, where the typical value is 700 to $1 million. We're seeing $50,000 to $80,000 variances between each one. And in theory, it's just different algorithms working off the same data. They should all be looking at the same underlying data. It's just, how does an algorithm go about it?
And a good example is, we have the ability to use, this is going to go, one of the things he just mentioned is, here in California, we can pull title reports on property and look at owner history, if you will, and it gives us certain factors. And one of those factors is it gives us an idea of what the value is based on comparables and what have you. It's kind of their own system that they do. It's called the Real AVM, and it's essentially a number, right? And they also give you a range. The property that I talked about earlier that we're going to list for $949, it told me that it was worth $768. So, I mean, it was only off by almost $200,000. So, yeah, don't count on that stuff. Get a professional to help you out.
Hey, Jeb, a couple here. This is a quick and easy one. Moonlight Sunrise, one of our favorite guests here.
Yeah.
Can you lend if I'm buying in South Carolina? Also, how soon can I lock, and how much does it cost? Can't help you in South Carolina, but like Jeb loves to point out, email Jeb, email me. We have a huge network. I've introduced Jeb to a friend of mine in South Carolina that can do a great job for you. So either one of us can connect you to Jason. You can lock immediately once you have a property identified, and we just need to know when we're going to close. And there's no upfront cost. The longer the lock, the worse the pricing will be.
There you go. Here's another easy one for you. How often can you refinance, Josh?
As often as it makes sense. A lender makes us provide a net tangible benefit. So we can't just be doing it for our benefit. I can get paid over and over and over again, but you're taking worse terms. We actually have to show a worksheet in the application, in your loan package, that shows how you're benefiting from that. What I would say, something that's not often known, a lender, when they do a Fannie Mae, Freddie Mac, FHA, VA loan, a loan that gets packaged and sold into the secondary markets, they are warranting that for 180 days, that loan won't pay off. That is not a prepayment penalty to you, but let's say you did a loan with me today, and in 6 weeks, you went out and refinanced that loan with someone else. I'm going to pay back what I earned on that loan. And the reason why that's important is the vast majority of the loans that we do, and most borrowers do now, you're not paying any points. You're not paying anything for that loan. The lender that's buying the loan is paying us. So what happens is we have to repay that. So I like to go through it with our customers. I mean, if the market moves incredibly rapidly downwards, at a minimum, I would love to do the next refinance for you. We make a commission on that 2, 3, 4 months later, and we use that to pay back the commission from the first one.
No, absolutely. Got a couple good ones here. This one, do you have a realtor in the Beaverton, Portland area. I actually have a great realtor in that market. Fantastic realtor, in fact. So if you want to reach out to me, do that, and I will put you in touch with Ben. He's a good dude. Here's one. I think this is a good question. I have a condo which I want to sell and buy a house. Will a lender give me a loan based on this? So I assume house isn't going to be sold. They want to buy something maybe prior to selling that condo. How does a lender look at that? What are the options?
It's difficult. You have to be really well qualified to pull this off. People will ask, so if you have enough of the down payment for the new purchase and you qualify for both, no problem. If you need the equity from the departing residence, you can do a bridge loan, but people think that a bridge loan means that someone's going to give them all of their equity. They're not. They're going to give them 70 to 80% of the value of the home. So most people plan on leaving the departing residence and transferring all that equity over to the new property. So that means that you're going to be short 20% of your equity on the other property, which there's ways to structure around it, but it's one of those ones where it's a very unique situation. Each one, there's a bunch of questions here that we would have to ask to get you an accurate answer, but you can do a bridge loan. If you have, let's say you have enough of the down payment for the new one and you want to close before selling the current residence, if the current residence is under contract and all contingencies are removed, we can exclude that payment. So it doesn't happen often. I've only done 2 or 3 of them in 26 years of doing loans where we have a departing residence that's sold and all contingencies are released, but it hasn't closed. But it happens every now and again.
All right. So I saw one here. So I saw this one earlier. They just put it up again. RB asked, Texas federal judge rules CDC's pandemic eviction moratorium unconstitutional. How does the decision affect other states and the housing market? I don't think it's going to affect it personally. This sort of thing goes to, if it really happens, right, probably goes to Supreme Court. I don't know. I don't know what happens with the decision, right? In some of these states. I mean, I know that Texas in the moment's opening up or just opened up. States like California, for example, nothing's going to change. I don't care what happens in Texas. Newsom ain't doing anything here in California, unfortunately. So, we're going to have the moratorium in place. States like New York, some of the bigger, states, probably the blue states are going to have moratoriums in place. They're not going to rule against this sort of thing and change anything. I don't know, Josh, anything you want to add to that?
No. It's about the same thought. And again, anything that Texas does will get challenged and it will go to a higher court and there'll be stays and appeals and all that fun stuff.
Yeah, it's not going to happen anytime soon. Another one here that's a good question. Is there more than one way to get rid of PMI? So let's talk about PMI first, right? So PMI is something, if you're not familiar with it, required when you put less than 20% down when you buy a property. FHA loans have PMI that are on it for the life of the loan. And then conventional loans, you have PMI when you put less than 20% down. So how do you get rid of that, Josh?
So for the most part, you have to have it for the first 2 years. The reason for that is the lender wants it there for a reason, and they're buying the loan based off of that. And they want to make sure that you have a good payment history. Let's say you have an 800 credit score and you're the greatest borrower ever. They still want the 24 months to show that you're making the payments on time. From there, let's say you put 18% down. You may have paid it down to 78% of the loan value in a few years. And at that point, it's supposed to be taken off automatically. Most people, when they're asking this question, it's not a matter of it coming off automatically. They put 5% down, and in 3 years, the market went up 17%. Now they have 20% equity. You would have to petition the lender. They might do an automated valuation, something like a Zillow Redfin type model where they push a button and get an AVM value. Most likely they're going to require you to pay for an appraisal, and then you can go about getting rid of it.
Or your other option would be potentially refinancing, right?
Yeah.
Refinancing into another loan. Maybe you're able to lower your rate. You're going to have an appraisal at that point. Maybe there's a waiver. Who knows? But that would be another option too. So this is a good one. It comes up quite a bit. Luz Quintanilla. Luz Quintanilla.
I probably butchered it. What you did is way worse than butchering it.
Credit Karma, good credit indicator for your credit score. So this is a common question. You want to jump on it?
Yeah, from the mortgage perspective, it's a different model than mortgage credit scores use. For the most part, it overstates anywhere from 10 to 30 points. So if you're trying to reach a critical threshold, like getting to a 680 credit score or a 740, and you're just above it, I wouldn't rely on it too much. If you're looking to get a general idea, or if it says you have an 800 credit score, I always tell people I'm pretty confident it's going to come back less than 800, but if you're anywhere near 800, you're getting the absolute best terms anyways. So for government loans, FHA and VA, it's important to get above 680 to get the best credit scores. For a conventional loan, anything above 740 is going to get you the best terms. And if you're in a jumbo, you truly do want the highest score possible.
All right. Stephen C here saying, hey, Jeb and Josh. What's up, Steve? If that's Steve Curry, man, and you're watching in Bali, what's up, buddy? Probably about to go surfing. Let's see what other question. Josh has a really good one here. Why does his mustache smell like trout?
I think he's hanging out in the wrong places, most likely.
Yeah, probably that. Yeah, I'm not going to go there. All right. Let's see here. Do you need to get an appraisal for a new construction purchase in California? James Choi.
Only if you're getting a loan.
Right. So
James, anytime, and James, actually, you've talked to James, I've talked to James, and the funny thing is, I didn't recognize James' name when it popped up, but I recognized his avatar there. So yeah, if you're getting financing, the lender is always going to require an appraisal. It's a little bit of a unique process because on the new construction, it comes way late in the game. Or we get it done when there's still flooring and appliances and stuff to be put in. And then once you get the utilities and everything turned on, we'll do a 442 inspection for the appraiser goes back out and says, yeah, the house is ready to go and the value is good.
All right. Here's one that's a little ways up. I'm kind of going back up just a little bit here to address a couple of questions. Clips them easy is always here. Thanks for joining us and always putting in feedback. The rule of thumb says people should not spend more than 24% of their income on their monthly mortgage payment. Based on what you're seeing, are people buying homes that are above 24% of their income? I don't know who the rule of thumb is there with the 24%, but I've been doing this. I was mortgaged for a number of years, 10 more. Doing it now, yes. I mean, people are spending more than 24% typically of their income, but it's not just their housing. It's related to other things as well. But go ahead, Josh, if you want to jump on that.
Yeah, rule of thumbs are just that. It's a conservative. 24% would be a conservative figure. I would tell you that if I went through and analyzed every purchase transaction we did last year, which the purchase debt to income is generally a little bit higher than on refinances, just because the loan sizes end up being a little bit bigger. But if I ran them for purchases last year, I'd say we're probably in the high 30s for the most part. And it's largely due to the fact that California is an expensive market. We do a lot of first-time buyers. The people that have lower debt to income ratios are the move-up buyers that have big down payments, that type of fun stuff. So for the most part, I see mid 30s. We do a lot of them in the low 40s. If you get much above the high 40s, I would like to know that you have something that's additional income that we can't use for qualifying purposes. Maybe you do Uber. Maybe you have a side business that you've only done for a year. Maybe you have a family member that lives with you and is going to help offset costs. It does. I mean, the crazy thing is on FHA loans, you can go to a 47% debt to income ratio. One of my favorite stories is we did a VA buyer for Jeb buying a condo here in Huntington Beach 2 years ago.
This is always a good story.
69% DTI. And 69 is not a dirty number, but it is a critical number in that VA calculation. I've never seen one approve at 70, but we've had a few in the high 60s, and that 69.4 or whatever it was for that gentleman was the highest that I've ever got approved.
And he's still there.
Still there.
He hasn't missed his payment. In fact, he's got more equity now. it was a good scenario. So just
And
FYI.
he's a perfect example of that, because in his situation, he had a girlfriend that was going to live with him and pay half the rent. So really, instead of a 69, it was a 35, because she was paying half of it, and that's why it's worked out well. And
No,
for
actually,
him,
she's gone.
oh,
She is. Yeah, true story. True story.
I jinxed him.
Yeah.
My apologies.
All
I
right.
need to
So
keep in better touch with our clients. You know, the girlfriend's gone, and I don't.
anyway, do sellers pay for the home warranty when selling? I'm just going to eliminate the OC and just say when selling. When I buy, should I be asking for one? Do homeowners hate them when making a claim? So do sellers pay for them? Typically, sellers do pay for them. I would say that 9 times out of 10, sellers pay for them. Sometimes the buyer, like in this market, when I'm writing offers for buyers, I'm paying for it if the buyer wants it, just because I'm trying to make our offer as clean as possible, not asking the seller to do anything. But traditionally speaking, sellers pay for them. Quick, kind of recap, if you will. What does it cover? Covers like the major systems of the home, appliances, dishwasher, the HVAC, the water heater, part of the roof, just basic maintenance items with the property that if they were to go wrong, essentially you pay a small deductible and they fix them, repair them, replace them if they have to. So should you be asking for one? Depends. I mean, if the property has mostly new, new HVAC, newer roof, new appliances, new water heater, all of that, probably not necessary because it's only good for 1 year. But if you're walking through the house, has an older water heater, older furnace, for $400 or $500, whatever it costs, it's kind of insurance, if you will, to avoid major things within that year. But understand that if nothing goes wrong in that year, you have to re-up it again. So it can be a waste of money. And then lastly, do homeowners hate them when making a claim? Homeowners aren't affected. Does the home warranty company hate when you make them is probably a better question. And I don't know if they hate it, but they're an insurance company, right? So they will always take the path of least resistance. If they can get away with doing the minimal or not doing stuff, a lot of times they argue it. But I will tell you, if you have a good real estate agent, a professional, they can talk to their home warranty rep and get things done that they might have denied otherwise, or they did deny otherwise. I'm seeing it all the time. In fact, I just had a client reach out to me that was having an issue with one of the service providers. She said, "Hey, can you do something here?" I called my rep. Within 24 hours, they had the issue taken care of. It was resolved. No issues, whatever. I've had people that have had water heaters they wouldn't replace. I made a call, water heaters replaced. So it's good to know professionals in the business that can do it. Do you need one? That's up to you. Hard to say. Josh, what does an appraiser look at when appraising a house? We talked about this briefly, but just we talked kind of a little bit different. But if they're appraising a property, let's not talk about the things that FHA and VA looks for, but how are they coming up with the value?
So they're going to come out and take measurements. They're going to make a sketch of the house so they know how it lays out. They're going to take pictures inside, and that all goes in the report. So now we have public records that they've already looked up that says, hey, this is a 3-bedroom, 2-bath, 1,580 square foot house. They validate and verify that. They look to see, yes, there is in fact a pool. All of the functions and features. And while they're there, they want to see, hey, this one backs to a freeway, or hey, it sides to a major street. It's across the street from a school, and they make note of all of those things. And then, as we said earlier today, it's a comparable sales analysis. So they're going to have 3 comparable homes, and because no homes are exact, there's a big, long list of criteria that they compare them to. Is it in a better condition? Is it more or less upgraded? Does it have AC or not? Does it have a pool or not? Does it have a garage? How big is the garage? Does it have RV parking? All of those things can add or subtract from the value, and they come down to an adjusted value. And they compare those 3 comps, and they come to what they think is the most reasonable assessment of what the number is. And for the most part, in a normal market that's not going insane, on a purchase, it's going to come in really close to the value. If it comes in low, it's a tiny bit low. If it comes in high, it's a tiny bit high. But 99 times out of 100, it's dead on right at the number of whatever the sales price was.
Awesome. Got a couple here that I want to talk. Well, first, Matt saying, I hope he finds a new girlfriend to split the mortgage. Yeah, he probably does as well. Um,
It sounds like Matt might have a girlfriend he's trying to offload.
All right. So La Echo Super 4 gave us a $20 super sticker earlier. So I want to get to their question first. If PMI is removed due to high home prices with appraisal, does it go back again if home values decline and LTV is more than 80%? Is one of the questions, but they also ask another same question. So yeah, so the answer is no. Once it's off, they're not going to add it back on if the value is less. So you should be all good there.
Team Blanco really needs an answer to this question, so we've got a couple of them here. Do you think mortgage rates will go up or down tomorrow? Should I lock or float? So again, really difficult to say with any certainty. Markets can remain crazy for longer than we think. My gut and the best experts that I follow are saying we are very near a bottom in bond prices, a peak in interest rates, and expect some correction. So if you have a reasonable level of risk tolerance and you don't need to close for, say, 10 to 20 days, I'd probably let it ride a week. If you don't have a strong risk tolerance and you just don't want to have to stress out over it day after day, go ahead and get it locked.
No, good stuff. If you're watching, you haven't already, hit the thumbs up there. That helps us and helps more people see it. And we appreciate when you do that. And if you're not subscribed, you can do that as well. So we have a couple here talking about different things. Put email addresses up there, Josh, so that we can, because I know you're going to have to get off here in a moment. I'm going to stick around for a little bit and talk. Just shoot it with the people here. People are asking about investment property. There's a couple different questions here. I'm not going to go back through all of them. But is it a good time to buy an investment property? So on and so forth. So thoughts on investment property, Josh, in general. I mean, obviously different markets are different, right? Southern California, the way I think about investment property are two ways. And Josh is probably going to approach this from a different perspective, which would be good. But you have going from when buying a property, are you looking for appreciation or are you looking for cash flow, right? In Southern California, very difficult to get a property that does both unless you put a considerable amount down. Property in California is more on the appreciative side, right? It will appreciate faster than most markets. Take Fort Wayne, Indiana, for example. Have a buddy that sells real estate there. Hot market, great job growth, great economy, good place to live. It's on all the top list. You could buy a house for $200,000. There's a lot of doctors moving to the area. Just it has all the right things that fit a good market, right? There you can put 20% down, $40,000. You can cash flow all day long. In California, you can't do that. $40,000 isn't going to do anything for you. So I think it has to come down to how much money do you have to put down? Where are you looking, and what are you trying to achieve through owning investment property, right? I mean, there's so many videos out there right now, the Grant Cardones of the world and all these guys pitching, investment properties and teaching you how to invest in real estate and all this crap. And it's not that easy. But Josh, I'm going to ramble here unless you jump in.
No, it truly is that. What are you looking for? So most people that are going to be asking us here are not someone that's coming out of a property where you're rotating to a higher quality property. Maybe someone could be asking that question and saying, hey, I bought a duplex in Inglewood, and when the stadium went up, values went nuts, and now I want to have a duplex in Newport Beach, and I'm going to take my $600,000 or $800,000 equity and rotate up to a new property. So for the most part, what people are saying here is, I want to buy my first investment property and get in. So generally, we're talking 20, 25% down at the most. In California, it's almost impossible for those to cash flow. The rents are so far behind home prices that it just doesn't work. So the majority of investment property purchasers are coming out of another property and for one reason or another, rotating into something that they perceive as better. The only reason why anyone would buy in the current market is just to be able to pursue appreciation, which for the most part in California over the long haul, nationwide home prices generally follow inflation, 2.5%, 3.5% over the long haul. California, going back to the 70s, I'd have to run updated numbers, but it's closer to 7%, 5.5%, 6%. So when you look at that, there's a rational reason if you can make the cash flow work to pursue appreciation. But one of the guys I was masterminding with last week, he's buying in Omaha, Nebraska. He's from Omaha. His goal is to have 120 homes, and they will all cash flow with a very minimal down payment. He knows he's never going to see the appreciation. He lives in San Diego. He's never going to see San Diego level appreciation. It's not about that. It's just trying to acquire cash flow.
No, and there is an exception to the rule, right? Especially right now. You have Airbnbs, you have these short-term vacation rentals that will appreciate and cash flow, but they come with risk, right? I mean, you could take Palm Springs, for example, here in Southern California, La Quinta area, huge market for vacation rentals. These things cash flow like crazy, and they appreciate, but the city comes out and says, hey, look, we're not allowing any more of these, or you can't do that because you've had too many violations, and now you have a property that no longer cash flows that you paid a lot of money for. What do you do then? So, there's a risk reward with a lot of this sort of thing. And I do think there are better markets outside of California if you're looking to invest in real estate. And if you are one of those people that are looking, reach out to me. I can put you in touch with some very smart people in different markets that can talk to you about real estate in those markets. And you have the opportunity for that cash flow. We had a couple of stickers here, or one from Moonlight Sunrise for $5, and one from Yulduz Abraham. I need a speech class, I think. My wife tells me my speech sucks.
We also got a wonderful pat on the back here from my friend Steven Chavez, who you connected with us here. He's been watching and looking at buying a new construction. I think actually he's working with Billy, right?
Yes. Yep. Yeah. They're out looking. So good stuff. Let's see here. So you got to run, Josh. 6:28, my friend.
Let's answer this one just before we go. It's a good question.
All right.
Do sellers discriminate against FHA buyers? If they do, what can make my offer more attractive?
And there's a couple of those in there that talked about FHA. So this is gonna answer your question as well.
You don't even need me. This is really a realtor question. There's limits. Jeb and I were talking earlier today, like, what do you do? What if we did a webinar or a class and just said, what do we teach you how to succeed in the market? The market's so nuts right now that I don't know that there's any great tips, but you still have to, if you want to make offers and you want to maximize your choices, Jeb, it'll be a good time for me to take my leave. I'll go pick up the wife, but you can cover this for him because it's a big question.
All right. So Josh is leaving us. I will throw Josh's information up at the end. I'm going to stick around for another 15 or so minutes, answer your questions. So if the numbers drop now, I'll know it's because you left. If they pick up, I'll know it had nothing to do with
it. It was like 1,500 soon. They were waiting for this guy to leave.
Exactly. So
all right, good night, kids.
All right, buddy. Thanks, dude. All right, guys. So I'm going to answer that question real quick. So do sellers discriminate against FHA loans? Not an easy question to answer. I will say I don't know that they discriminate on purpose on FHA loans, but typically what happens, you submit an offer on a property. The listing agent is typically the one that goes over those offers with the seller in most cases, right? So they're telling them purchase price, down payment, how much the escrow deposit is, what they're asking for in the offer. And, there is this idea, and it's not the right idea, but there are a lot of people out there that aren't properly informed. And when I say a lot of people, real estate agents that think FHA loans aren't great loans. And they think that because they associate FHA loans with lower credit scores, they associate FHA loans with minimal down payments and what have you. And unfortunately, those are realistic things. Yes, sometimes lower credit scores, sometimes or always lower down payments, but doesn't make them a bad loan. I've seen people qualify with FHA loans that are more qualified than those using a conventional loan because their debt to income ratio is a lot less. Now, what happens is when you put a couple of people beside each other, right now you're in a hot market. So sellers are getting multiple offers on properties, bidding above and beyond the asking price. And so you have people kind of vying against each other. So if you put somebody that's got 20% down against somebody that has 3.5% down, they are probably going to lean towards the person putting 20% down. And a lot of times right now, appraisal is a concern for the seller when somebody's paying above and beyond the asking price in a lot of cases. And so sellers are asking for, people to waive appraisals and what have you. FHA, you can't really waive the appraisal. Even if you say you're waiving the appraisal, it's not a true waiver because there's an amendatory clause with the contract that protects that buyer if they wanted to back out if the appraisal came in less. So sellers are more hedging themselves by not going with FHA loans than they are discriminating in the way I look at it. And it's tough, right? I mean, if I have two offers that are similar, I'm not really concerned with an FHA loan in most cases because I'm doing my due diligence on the back end, speaking to their lender, finding out what their debt to income ratios, finding out certain things about them. And the FHA loans are less restrictive, in fact, than conventional loans. They're a lot of times they're easier to qualify for, so less likely to fall apart if something does go wrong. But when you're in a market like this that's super competitive, you're trying to take the path of least resistance, the least issues. And so a lot of times FHA gets pushed to the bottom of the pile because of that. And the same can be said for VA. VA loans are for veterans, people that have served in the military, and sometimes spouses and what have you, depending on the circumstances. And they are no different. They're getting shunned in this market, and it's not cool. I don't like to see it because I don't think it's fair. In a more balanced market, it's not really an issue. So hopefully that's a long way of getting to your question there. So let's go up here and say. So Alex is asking a question: can I refinance my primary and rental properties at the same time? The answer is yeah, absolutely. You can do both at the same time. Clearly, you got to qualify for them both, but sometimes it makes sense to do one and then do the other because maybe your debt to income ratio is lower by refinancing one first. But if a lender can see if you qualify, then there shouldn't be any issues with doing both at the same time. So Elizabeth is saying FHA loans are annoying for sellers. They usually have multiple minor repairs that need to be done on the home before inspection will pass. No, not necessarily. Yes, FHA does call out chipping paint. They call out, some, if you don't have smoke detectors, health and safety items. But honestly, like the last couple deals we've done, FHA not been an issue at all. So I wouldn't say that sellers decline because of that. It's more of a guidance from a listing agent telling sellers about offers than it is the seller make the decisions. Most of the time, the sellers have no idea what the offers are or how to go through them, and so they're counting on that professional they hired, quote unquote professional, to guide them. And sometimes they're not getting the proper guidance in some cases. All right, so we got Dr. Baez Dental Group. Thank you very much for the super chat. Much appreciated. So I'm just reading some questions here. So Tyler is saying using VA made 9 offers, no closing costs with no luck. Is there anything I can do to make my offers more attractive? So I've talked about making offers more attractive multiple times. What can you do to help stand out? It's a tough question because there's really not a lot. I mean, you can shorten contingency periods. You can waive contingency periods. You can not ask for small fees in part of your offer. Like, for example, us here in California, we have termite inspections, termite clearance. VA, you have to have them, but if you're doing a conventional loan, you could not ask for that sort of thing. You could not ask for a home warranty, putting a larger deposit down. Your earnest money, your escrow deposit will help you stand out. I've talked about using an escalating clause in other videos where you can, structure an offer where you can offer more than another offer by bidding above that offer without seeing that offer. It's called an escalation clause. So, you could say, I'm willing to offer $1,000 more than the highest offer up to a certain price, or up to any price for that matter, just to help your offer stand out. So those are some of the things you can do. But honestly, in this market, what I'm seeing is it comes down to price in most cases, right? I mean, price seems to be the number one thing. I mean, I even have clients now that are making offers that are well above the asking price, and we're still having issues. Multiple clients, same problem. So there's not really a lot, honestly, that I could give you. I wish I could sit here and tell you that you could do these 5 things and you were gold, but the reality is that's not the case, especially at the moment. But shortening contingencies are one of those things I've seen. I was on a video, a live with Matt, the mortgage guy, couple weeks ago, and he said that up in his area, he's in the Sacramento area, that he's seeing buyers now just make the escrow deposit, the earnest money, non-refundable. I mean, refundable, non-refundable up front. So basically, if they go under contract, the earnest money is the seller's, regardless of what happens. People are doing crazy things in this market, and it seems crazy, but if you know that's the property you're going to purchase, you love it, you qualify, maybe you do something like that. Not something I recommend, but those are things that you can do to help your offer stand out. And another thing you can do or try to do is try to see if you can present your offer in person. Maybe not truly in person just because of everything going on with the pandemic, but maybe you could, Zillow, you could Zoom or Google Meet or something to try to meet the seller face to face to present your offer. That stuff works. In a market like this, though, that's hot, chances are sellers aren't going to, do that sort of thing if they've got 50 offers on the table and one is better than the other. So let's see here. So USDA, no, there's no appraisal waivers with USDA, FHA, or VA. You're going to have appraisals in those cases. Now, if you're doing an FHA or a VA streamline, those are refinances. With FHA or VA, the interest rate reduction loans, those, there are no appraisals. So in those cases, you don't have appraisals. But if you're buying using those, you're going to have appraisals. Cisco looking to purchase in Orange County, Placentia, Orange, and Yorba Linda, losing my offers with other buyers offering rent back. Yeah. I mean, yeah, what you could do the same thing, right? I mean, it's all about appealing to the seller in this market. So what can you do to appeal to the seller? Your listing or your buyer's agent should be reaching out to the listing agent to say, hey, what's important to the seller? Do they need more time? What are they looking for in an offer, what have you, and then trying to cater your offer to as much as that of that. So if you're, for example, if the seller says, hey, look, they need some extra time, they're moving to Arizona, but their house isn't going to be ready for another month, then you could, make your offer appeal more by offering rent backs and that sort of thing. So there are certain things you can do to help stand out, but understand if you're getting a loan, the lender is not going to allow anything more than a 60-day or anything more than a 60-day rent back. It has to be less than 60 days per lender guidelines. Ashwini is asking a question. What is your suggestion on strategy to buy in the market with selling agents asking to remove loan contingency and buyers with 50% down payment? I'm in SoCal and getting overbid on every offer we put in. So, it's hard for me as an agent to recommend that sellers waive, loan contingency, appraisal contingency, all of these contingencies. One thing I do when representing buyers is find out how well qualified they are at the current price. If my client is going through Josh, I trust what Josh says, that they're going to be solid. But waiving these sorts of things aren't, it's crazy, because what happens if you lose your job next week or something happens? There's a lot of risk associated with it. It really comes down to comfortability in what a buyer is willing to do. Buyers are willing to do some of these things. As an agent, I suggest certain things or give my opinion on certain things, but it's only that. It's not telling somebody what to do. And you can, I advise people and say, hey, look, if you did this, maybe your offer stands out a little bit more. Not necessarily something I recommend, but what do you want to do? And in some of these cases, buyers are willing to do that. So not something I recommend, but in this market, it may help you stand out above the competition. All right. So got some more questions down here. Arthur's asking about lumber prices, what have you. Obviously, I don't follow that quite as much, but we talked about it earlier. Chances are you're not going to see much pullback in any of that anytime soon. It's back ordered. The costs have gone up. There's just, new building, new construction, not enough out there. It's chances are you're not going to see much change in that realm. So likely to continue. Would there be more inventory post-vaccination? So earlier I talked about inventory a little bit. If you want to go back and watch it, give a better explanation of what I think might happen to inventory soon. But, post-vaccination, yeah, I think you could see a pickup in inventory. I think you're going to see one anyway here in the next couple of weeks to months, just because it's cyclical. Spring housing market, we typically see things pick up. I think this year is going to be much the same. I think you're going to see inventory pick up a little bit, but what does that actually mean? I don't think it's going to be enough to change the housing market, so to speak. But it might be one where instead of getting 20 offers on a property, you only get 10, or instead of getting 5 offers, you get 2 or 3. I think it's going to give buyers more options, but I don't think it's going to be enough to slow demand or slow things to a point where you're going to see any real changes in the market at this time. So, but as vaccinations, really go into effect, which could be 6-8 months, a year from now, really, I don't know what the housing market's going to look like. I think, for the foreseeable future, supply stays low, buyer demand stays pretty similar to what it is now. And the market looks a lot like this probably a year from now, in my opinion. It's a guess completely, but just based on the people that I follow that are a lot smarter than I am, they have a better grip on a lot of those factors, and I trust what they say because I've been following them for a long period of time, and where I get a lot of my information. So all of a sudden I have like allergies. I'm super stuffy in here, so I sound like very nasally. Let's see what kind of questions here. If you dance for the seller, you think I can get my offer accepted? I'm desperate, potentially. I in this market, crazy things are happening. Every day I'm surprised and shocked by the things that people are willing to do. And, dancing would be near the bottom of that list in the crazy things that I've seen. So am I seeing buyer's remorse? Not yet. I have read stories about buyer's remorse. I personally haven't seen it, but I know it's going to be out there. It's just the market is moving way too fast for there not to be buyer remorse. There are people that are, bidding on properties sight unseen, buying properties out of state in markets that they're not familiar with, maybe buying without ever seeing a city that they're going to. There's just, you're going to have buyer's remorse, and you're going to have people that buy property that have done inspections and what have you. And then, because they've had the fear of missing out and they've purchased something that truly didn't meet what they wanted to have in a property, or maybe in an area that they would have never considered prior to this, but they considered it because of what was going on. That is going to be the reality. And you're going to see more of that in coming months to years. You're going to have people that bought stuff that they look back and weren't happy with for one reason or another. And I think it's going to, how much of that, it's hard to say, but it's definitely going to happen. All right. Let's see what we got. Just trying to find some good questions so everybody can benefit here. So asking James. Okay, here we go. Well, these questions are all asking each other questions. So so once you have the appraisal, you just have to hope that it comes in close to your offer price and have the money to cover the difference. I've been asking okay, so goes back to asking a question. Basically, what I'm assuming would be something along the lines of if your appraisal comes in less, what do you do? because there's a lot of people waiving appraisal contingencies at the moment. So it's a good question. And so if you've waived the appraisal contingency, you can't use the appraisal to back out. Doesn't mean you can't try to renegotiate it. You can definitely try, but chances are you're going to have a hard time with that. So if a property doesn't appraise, so say for example you buy a property for $500,000 and it appraises for $475,000, you've got to make up the difference in that $25,000 based on how much you're financing. And so that either comes from the form of bringing in additional cash from, to close, and or you have to negotiate the seller to work with you there and maybe split it, or pay for it to try to get that amount down. Outside of that, there's not really a way around it. Now, you can't use appraisal to back out, but in the state of California, you have 6 contingencies when you buy a property. There are other things you can use to back out of a property outside of appraisal. But if it solely has to do with the appraisal, then you can't back out. But that's the way to make it up. And right now we're seeing a lot of properties appraise, even when they're going $50,000, $60,000, $70,000 above the asking price in some of these cases. These things are appraising, because what happens is when the appraiser comes to the property to appraise it, the listing agent is saying, hey, look, we had 30 offers on this property. There were 25 people that were willing to pay this price. And appraisers are using that to justify value because, at the end of the day, regardless of, an appraiser appraising property and using comparables, that's typically how they do it. They find comparable properties and that's how they come up with the value. A property is worth what somebody's willing to pay for it. So if you've got 25 people willing to pay whatever that price is for the property, appraisers are using that. How they're using it exactly, I'm not sure, but they're using that to justify their value and how they adjust the other comps. So, we're not seeing as many appraisal issues as you would think. And right now there's also appraisal waivers out there that are taking care of some of the appraisals too. If you haven't done so already, hit that like button and subscribe if you like all things real estate related. Is it smart to take your down payment from your 401k to put down on a home? Tough to say. That's one of those questions, to each his own. If you need a home, if you're in a position where you need to buy a home for whatever reason, you have a growing family, whatever the reason is, it could be, it's fine. And basically you're just borrowing money from yourself to do it. So I don't think there's anything wrong with doing it. Is it smart? I guess it depends on, if you have, what you're looking at, how much is your 401k making in a year? Normally, that's one of the things you have to consider, right? It's not as simple as just saying yes or no. And is it smart? I would say you got to weigh a couple of different things. But if you need a property to live in, for shelter, for whatever reason, there's nothing wrong with using your 401k to do it. Essentially, it's just a loan against yourself. It's something you're likely going to, depending on how it's structured, you're going to pay it back. So you're going to put the money back in there anyway. So it could be a way to get into property if you have, the opportunity to use a 401k. Somebody here asking, can I bring comps to suggest on an appraisal? So, typically appraisers want to use the most recent comparables. I know you had Team Blanco's asking questions here. Can I bring comps to suggest, comparable properties 90 days out and within a mile? Yes. The shorter time frame, the better. If they can't find something within 90 days, they typically go out, maybe 180. They won't go past 180 in most markets, which is 6 months. So they're trying to find something typically within the last 3 months that's comparable to the property within a mile. Now, if you live in a rural area, not as easy to find those comparable properties. So you might have to go out further to do that. And so the second part of that question is, can you bring comps to suggest? No, but you could give them to your agent to bring to the table. Now, appraisers in this market don't have any conversations with the buyer's agent. They only talk to the listing agent. We as buyer's agents, if we're representing buyers, can't have a conversation with sellers. So But we do talk to listing agents to try to see and make sure that they're doing what they need to do to help bring the value in. Excuse me. All right, I'm going to do one more question here and call it a night. My voice is gone. Trying to find a good one. In fact, I might just call it. My voice is gone here, guys. So we're roughly running on 2 hours. I greatly appreciate you guys watching. I'm going to throw up my contact information so you have it. If you want to reach out to me, here's my email address. Email me if you're looking for a real estate agent, you're looking for a mortgage professional in your market. I'm happy to have a conversation with you and point you to somebody who can help. If you have questions, I'm definitely there. I will help you on those as well. Just give me some time to get back to you. I get a lot of emails, especially from viewers, and I want to go through and I want to answer people. So you can leave them on the comments or you can reach out to me directly. I greatly appreciate you guys' support. I don't know if I come across as appreciative, but I am very appreciative of all the support you guys give me, and continue to give me. So thank you very much for doing that. I only ask one favor, just like the videos, subscribe, and comment if you like the stuff and or have questions. So thank you for taking the time to watch. We will be back next Wednesday. Hope to see you again soon. Have a great day. Bye-bye.